It's going up. It's going up a lot. And let me just back that up a little bit because that's easy to say. I don't say things like that without a lot of analysis. There are three different ways to think about it. One is just some technical analysis. This is the third great bull market in gold in history. And when I say history, I'm only going back to 1971 because prior to 1971, gold was money. So you didn't have a bull market or a bear market. It was fixed to the dollar. The people who bang the table and say, give me a gold standard, I'm like, well, be careful what you wish for, because in a gold standard, you're not going to make any money on gold because it's fixed, it's pegged to the dollar. If you want to make money on gold, you would actually be against a gold standard because they keep screwing up the currency and the gold goes up. But we had a bull market from 1971 to 1980, and gold went up 2,700%. Then we had a bear market from 1980 to 1999, and gold went down from $800 to $250. So that's, do the math, that's 60 or 70%. Then we had the second great bull market from 1999 to 2011, and gold went up 670%. Then we had a bear market. It's so funny how these things go in cycles from 2011 to 2015, but you can call the bottom. It was December 16th, 2015. Gold was $1,050 an ounce. I'm talking US dollars. That was the bottom. And I saw it at the time, and I called it at the time based on a conversation I had with Jim Rogers, who's the greatest commodities trader in history. And we were down in the Dominican Republic at Casa de Campo during the bear market. I said, Jim, what do you think about gold? He goes, well, I own it. But I'm not buying more at the moment. I'm waiting. He said, I'm not selling it, but I'm not buying more. I'm waiting. And he said to me something that just hit me right between the eyes. He said, gold is going to the moon, but no commodity goes to the moon without a 50% retracement along the way. There comes a time when it drops 50%, and then there's like the second liftoff, and then it goes to the moon. Now, take the bottom in 1999, it was $250 an ounce. The top was $1,900 an ounce in August 2011. So that's $1,750. Half of that, so 50% retracement would be down $825. So 1,900 minus $825 puts you at 1,075. Well, bingo, 1,050. That's close enough for government work, as we say. So when I saw 1,050, I talked to Jim Rogers about this earlier. When I saw 1,050, I said, okay, there's your 50% retracement. Using 250 you have to have a base. Using 250 as your baseline, up to 1,900, take that gap, down 50%, boom, 1,075, we were 1,050. I said, that's the low. Now it's getting close to 1,900 again. I mean, actually, on an intraday basis, I think it just kind of kissed the all-time high. It was like right there. So there's the full retracement of the bear market, but this bull market, the third great bull market, started December 2015. We are up almost 90%. You go from 1050 to 1900, that's about 90%, 86, 87%. But bear in mind, the last two bull markets, remember what I said, 2,700% and 670%. So 85% is great, but when you get into like 600, 700, 800%, or 2,000%, you're talking about $15,000 by 2025. So if we just did the average of the two prior bull markets, I'm not even talking about the higher of the two. Take the two bull markets, average the duration and the gain, and then apply it to December 2015. You get to the exact number is $15,000 by 2025, $15,000 an ounce by 2025. But people go, that's 4 years away. It's like 5 years away. I was like, yeah, but to get to from 2,000 to 15,000, you got to go 3,000, 4,000, 5,000, 6,000. You can make a ton of money. So that's where it's going. Now, could it go down tomorrow? Sure. I mean, the gold's volatile. I don't get too hung up on it because I'm kind of a buy and hold person. You know, I don't get too euphoric when it goes up, but I don't get depressed when it goes down. In fact, when it goes down, I like to see it go up for our listeners and our readers. But personally, I don't mind when it goes down because you can buy more at a cheaper price because I know it's going up. I know where it's going. So the answer is, and just a little, again, sixth grade math is usually sufficient. When you get to higher levels, a fixed dollar increase is a smaller percentage increase. So people go, oh, it went from 1800 to 1900, it went to 2000, 2100, and that's a big deal and good for all of us. But those $100 increments get to be more and more frequent and more common because they start looking like 1/2 of 1%. 1/2 of 1% is not a big deal in the market. So you're going to see that on a daily basis. So my advice to people, of course, is buy gold. But I said that at 1100, 1200, 1300, 1400, 1500, 1600. You know, I've said it all along, and people don't buy it. People also accuse me. They say, "Well, Jim, you're just talking your position. You know, you're just trying to sell gold." I'm not a dealer. I don't make any money. If you buy gold, good for you. But I'm not in the business. I'm a writer. I'm an analyst. But I'm not a gold dealer. I'm actually one of the few analysts, apart from yourself and a few others, who are not gold dealers. But I think that gives you more credibility because you're not selling gold; you're understanding gold. But for anyone who hasn't bought it yet, of course, denial is a powerful thing. They'll say, "Well, I missed the boat. Now it's up the side. It's going to go down." You haven't missed the boat. I mean, again, 90% is a good run, but this is going to go multiples of that.
All right, let's explore a bit further into what we've discussed regarding gold. So, we've been observing gold values climbing quite a bit recently, and there are several elements behind this movement that we can analyze. To begin with, when we examine the past of gold values since 1971, we can spot 3 significant phases where gold values escalated. These phases are commonly known as bull runs, and they're marked by continual growth in the value of gold. The latest bull run commenced in 2015, when gold values were comparatively low. Since that point, we've seen a notable upward movement, with gold values increasing by nearly 90%. Nevertheless, if we contrast this present growth with earlier bull runs, it might appear somewhat limited. For example, previously, we've witnessed gold values soar by 2,700% and 670%, making the present rise seem relatively smaller. Now, thinking about the coming years, certain analysts are offering daring forecasts about where gold values might be going. There's speculation about gold hitting an astonishing $15,000 per ounce by 2025. That's a significant leap from where values are today. But naturally, we must acknowledge that the journey to that valuation might not be entirely smooth. Gold values can be rather unstable, implying they can undergo large swings in the near term. Regardless of this instability, numerous investors still consider gold a worthwhile resource to include in their holdings. That's because gold is known for preserving its worth across time, particularly when other assets could be underperforming. So if you're contemplating incorporating gold into your investment portfolio, it might be wise to think about it for the extended term. In short, the narrative of gold is one of endurance and potential. While we can't foresee precisely where gold values will head in the future, recognizing the historical patterns and present market factors can offer meaningful understanding for investors aiming to navigate the realm of commodity investment.